Welcome to the fourth class in the Corporate Finance Lab 4125. I'm really excited to kick off financial modeling part of our class. It'll go through the next 3 classes. Today we will cover just kind of the background. We'll download financials, get the model set up, and then we will build projections next class. And the third class, this will be the one before the last one in the series, we will build a LBO model. LBO is fairly advanced topic, so I hope you're excited about it. This is the core material. I'll make sure to include it in the final. You'll also see that there is bigger weight given to assignments in these 3 classes. And I also up to the challenge in the sense that you will be creating a model for another company. So you'll see me do the financial model for Home Depot, but I would like you to create your own financial model for a competitor of Home Depot. And you'll have to turn it in before the class. So this lecture is really all you have. I hope you're watching it well before the class and before the assignment is due, because I really want you to practice on your own. This video recording replaces what I usually provide in class, and it gives you an extra opportunity to practice on your own, listen at your own speed. But the feedback I received in my prior classes is that there was not enough practice for this particular financial modeling exercise. So I'd like you to practice on your own, turn in your assignment, and this way you'll be well prepared for the final exam. Well, with that, let me turn to some slides. It's fairly high level, but it'll be good to start us going with the discussion. So before, we are not going to do the model yet. Just sit back, listen to my discussion. I'll kind of introduce you to what we'll be doing and give you a bit of a preview. So in this slide, I just kind of recapture what I talked about. You're right in the middle of the course. You see the agenda. So today is the first class for financial modeling. So when do we need to build a model in real life? And the applications are limitless. I've built it as an investment banker, in particularly for any M&A activity and for mergers and acquisitions. You could build it if you're working for a private equity firm on leveraged buyout, and we'll cover LBO later, as I said, in the third class after today. It could be for any financing decisions involving company and company's financials. What do we mean by financial model? It's really a projection of 3 financial statements, of income statement, balance sheet, and cash flow statement. So whenever you look at historical financials, question frequently comes up, well, what the future is going to look like. And the future could be, depending on the application, could be weeks, months, years. So it's really kind of dependent on the use case. Step number 1 in financial modeling is to spread financial statements or populate the Excel file with historical financial statements. We'll download, I think by default, about 10 years from FactSet. We don't need that much. Usually 3 to 5 years suffice. We'll have a big shortcut from FactSet. When I was a banker, it was absolute rule that we had to get financial statements from original filings. We would download them from SEC in a PDF format, and then even though I was highly paid a professional, I would manually put in information by hand. It just ensures quality, ensures that no one else is making simplifications or kind of some standardization. FactSet will do that for us. So I want to give you caution that, you know, what we'll download from FactSet is not necessarily how Home Depot or other companies report their financials. We'll use standardized format. It makes things simpler, but if you look at the actual filings, you'll see some miscellaneous small items specific for the company, which FactSet kind of standardized for us. They've aggregated them, they've put in wherever they think these items fit. So just kind of word of caution. But for today's exercise, it's not so much about analyzing historical financial, it's more about building forward-looking model. So I'm not going to spend a lot of time on normalizing financials or standardizing them. So once we've downloaded 3 financial statements from FactSet, we will do some formatting, just kind of lay it out in the format that will help us build the forecast. And as we do that, we should be thinking about, well, what are the drivers? And drivers is an important concept. It's a variable that you'll kind of apply a formula to and then build a forecast. So we will calculate historical values for these drivers. And here you see some of them. For income statement, we will forecast revenue based on growth. So we'll look at how much revenue grew in the past. We'll calculate revenue growth, and then we'll make an assumption for the future. And we look at a variety of sources. We'll look at street consensus. We'll look at our kind of historicals, and we'll make a judgment of what we think the right value for the driver is. But it's important to set up the right drivers. So on this page, you see drivers for income statement, and they are fairly high level and simple. The goal for this exercise is not to get deep into the business side of Home Depot, but it's more about mechanics behind 3 financial statements. So income statement forecast is relatively simple in this example. Cost of goods sold, will set it up as a percentage of revenue, and gross margin, revenue minus cost of goods sold, will be the result. You know, it will be revenue minus cost of goods sold. So sometimes you see people making assumptions for gross margin and then they back into cost of goods sold. It's effectively the same thing. For SG&A, sales, general and administrative expense, we will also look at historical values for SG&A as percentage of revenue. We'll calculate SG&A margin, and we will make an assumption on that percent going forward, and then we'll apply that percent to revenue. So it's kind of like bootstrapping. So we've got revenue, we apply margins, we get costs. So it's kind of building one metric upon the other. So I'll keep going through these metrics. Again, today we'll calculate historical ratios, but I want to be clear why we're doing it, because we will be making assumptions for the future and we will be building forecasts based on these assumptions. So depreciation, we will forecast as percent of plant property and equipment, PP&E. So we'll calculate what that percentage was historically, and we will assume consistent number for the future. Effective interest rate, you could look at what Home Depot issuing its debt at what percentage, at what rate. But what we will do, we'll look at what their average or effective interest rate was, and we'll assume something similar for the future. And we'll spend a lot of time with that in the next 3 classes. So today we'll be mostly getting historical information in place. Once we've got that, we will build a forecast. And this is kind of just a little bit of brainstorming. This is how you could build forecast. We'll use even simpler approach, but I wanted you to be aware that there's a lot of thought and effort in reality that goes to forecast income statement or kind of the operations of the business. And like it's still fairly simple, but quite often what you would see is that revenue is forecasted as price times quantity. And simple example would be for oil and gas company. Their revenue could be forecasted as oil price times the amount of oil that the company produces, price times quantity. Or for a restaurant chain, you could calculate what the revenue per store is and what the number of stores is. For costs, as I mentioned, we will just assume a percentage, but in reality, assuming a percentage of revenue implies that all of the costs are variable, while in reality there is a fixed component. For example, there is only one CEO, one CFO, and as the business grows, their compensation does not necessarily grow proportionate to the revenue. So their salary is fixed more or less, and there's many other fixed expenses. So separating fixed versus variable expenses is a very standard way of forecasting cost of goods sold. For today's exercise, we will assume effectively that all of costs are variable, so we'll assume just one margin for cost of goods sold. Just again, wanted to give you different options, but as I said, income statement forecast isn't really the main topic for today's class. So we'll use a fairly simple approach to income statement. And just to kind of finish it off, when we set up the drivers for the historical information, we kind of use the same approach. So SG&A will be forecasted as percentage of revenue, and then interest income and interest expense will be built from debt schedules. So we'll cover that in detail. And when you see some small items like other income, unless you expect that income to continue, we will assume zero for some smaller items, just for simplicity. And when we look at the balance sheet, let's move there. These small items, they'll actually be flat. So for income statement, something that we don't think is material on income statement is zero. On balance sheet, you don't want to zero it out because it'll you'll have to allocate the change somewhere. So on balance sheet, I would suggest that you keep these smaller items flat. The key thing on balance sheet is forecasting current assets and current liabilities. So these formulas will allow us to forecast accounts receivables, inventory, and accounts payable. And what these formulas are, it's basically drivers. So when we do historical information, we'll calculate days in accounts receivable, days in inventory, days in payables. So these will be our drivers. And then when we calculate actual balances, then we'll reverse the formula. So you see that the numerator of the formula is accounts receivables balance. So we'll start with that, and then we'll start with days in accounts receivables with our historical value, and then multiply it by revenue divided by 365. So we'll reverse the formula and calculate the projection. And we'll do the same for inventory and days and payables. CapEx will be forecasted as percentage of revenue. So again, pretty simple assumption. Cash will be taken from the end of the cash flow statement. And here it's important to talk about circularity in forecasting. So cash appears at the beginning of balance sheet, obviously, but it is a result of all the activity in the company. So when you think about cash flow statement, it starts with net income, right? The net income kind of flows through revenue, costs, and you get a net income. And then in the cash flow statement, you subtract different investing and financing activities. And at the end, you arrive to net change in cash. That's what determines your cash. And then that goes into the balance sheet. So you've kind of created a circularity. So it's an important concept for financial modeling because it could result in some technical Excel problems, and I'll show you what they are. But I want you to be aware that there is circularity in any financial statement. Plant, property, and equipment. The formula for that would be prior year balance plus capex minus depreciation. And then investments and some other items, we'll just keep them flat. Or again, if we have a view, we can model them, but we'll probably keep them flat for now. So on liability side, we'll use the same formula for accounts payables. Accrued liabilities, we'll express them as percent of revenue. We'll calculate what that value, what that percentage is historically, assume similar number going forward. And then shareholders' equity, the formula is for retained earnings, beginning balance plus net income minus dividends and share buybacks for Home Depot. So continuing on to the cash flow setup. So as you, I'm sure know, operating cash flow is the sum of net income. So we start cash flow statement with net income and then add back depreciation because it's a non-cash item. So we subtracted it on the income statement and now we're just adding it back because it doesn't impact cash. And then similarly, if there are any other non-cash items, we would also add them back. And you'll see later in LBO analysis, we will have non-cash interest expense, or sometimes there are non-recurring items, or like management stock compensation. And these are all the things that are added back. And then the second part, getting to operating cash flow, is changes in net working capital. That's fairly important and detailed work that we will do. And what's important here is to understand this concept, and this applies to any item on cash flow statement, that if balance sheet item goes up in value from one time to the other, then increase in that asset is actually decline in cash. So think about accounts receivables. So if accounts receivables go up, most likely you haven't received cash. When accounts receivables go down, they convert into cash and your cash goes up. So, but then for the liabilities, if your liability goes up, then your cash also goes up. So as an example, you can borrow, go up, the liability goes up, you put the money in the bank and you've got more cash. So what it means for financial modeling is that we will take change in asset with negative sign. And then we'll take change in liabilities just as they are. So it'll be next period minus prior period, that'll be our change. And then going down on the cash flow statement, after we calculated cash flow from operations, we will calculate cash flow from investing activities. And what's included here is CapEx, capital expenditures. They are outflows, so they will be negative on our cash flow statement, and we'll kind of have to be careful when we calculate plant, property, and equipment to subtract. For PP&E, we'll actually add it back, so we'll just have to be mindful of the sign And then acquisitions are also outflows, but then if you sell an asset as a divestiture, then it will be an inflow of cash. For Home Depot, I don't think we'll have any items other than CapEx. And then cash flow from financing activities. So what's included here is dividends, share buybacks, any increase in debt or equity. So we'll kind of flow through that segment. And then at the end of cash flow statement, we will have a simple schedule that has ending cash balance, beginning cash balance, and then the difference is the cash flow during the period. So once we've set up the 3 financial statements, we'll have supporting schedules. That schedule is one of them. And different tranches of debt, they will be all laid out similar in the sense that they'll have beginning balance, and then they'll have drawdown or pay down. So drawdown is when we add debt, so the debt balance goes up. Pay down is, paying down the debt, so the balance will go down because of that. And then ending balance is just beginning balance plus pay down or drawdown. Very simple schedule. Sometimes I get questions on it, but there's nothing complex about that schedule. So after those 3 lines, and we'll repeat those lines for each type of debt. So below that beginning and ending balances, we will have interest expense. And then we'll have a rate, and then the actual expense will be the average debt balance times the interest rate. What's important here is average debt balance. And what it creates is circularity. So one instance I gave you was with cash. Another instance is kind of going from the beginning to the ending debt balance. So you're basically taking, so to get to the ending debt balance, you need quite a few components to get there. So when you take the average, you're creating circular reference in your model. And again, the reason I bring it to your attention is that circular reference could create a mechanical problem in Excel. So when we troubleshoot, and you may have questions, if something looks strange in your model and your numbers don't calculate, you've got some error messages, first thing I always check for is, are you dealing appropriately with circular reference? So I'll show you when we are in Excel, I'll show you kind of one thing you always want to do, and it's to enable iterative calculations. I'll show you that to you in Excel. So once we've got this debt schedule set up, we will calculate different tranches, different types of debt, and then we'll add up all the interest expense, and that'll go into income statement. Interest income will be calculated in a similar way, where we'll take a rate that Home Depot earns on its cash and the cash equivalents, and multiply that rate by average cash balance during the year. And that'll be our cash interest, which will also go on to the income statement. Now, this is an interesting topic, revolver modeling. Let me explain what revolver is. Think of it as a credit card for a company. So if your expenses are high in any given month, you can put those expenses on your credit card and kind of have a balance outstanding, basically borrow on your credit card. When you have excess cash, you can pay down that outstanding balance. Same idea works for the company. It's basically a type of short-term debt. And what it allows us to do, instead of flowing different, basically net cash, not changing cash, instead of flowing that through cash balance, our cash balance will be relatively flat. But what we'll do, we'll say if we've got more money, we'll pay down debt. If we've got less, if we need to borrow, then it'll be reflected in our revolver. So revolver will be that balancing line in our balance sheet that kind of balances everything. Now, this is an interesting page, and I'll walk you through it again in Excel. But it basically illustrates a revolver. And I find that people rarely teach this in textbooks. So it's good for us to review it together. So one concept that we have here, the first line, is cash flow before revolver. So it doesn't show up as a line on your standard cash flow statement. We'll have to calculate it. And think of it as all changes in balance sheet, like all lines on cash flow statement before you have to draw on revolver. So when you think about cash flow statement, you've got your net income that goes into cash flow from operations. So you start from cash flow from operations, subtract CapEx, subtract other changes in debt, again, other than revolver. So that'll be cash flow before revolver. You could also use cash balance for that. So a cash available, cash before revolver would also include cash on the balance sheet. So all cash that's available to pay down the revolver, which should be included there. So once you calculate that cash flow before revolver, you then, you see in my second sentence there, you calculate pay down or drawdown. And the formula is fairly simple. It's negative minimum, so the smaller of cash flow before revolver that we just calculated, and beginning revolver balance. What this formula does, there's three options that I'm describing on the slide. So if our cash flow is negative, meaning that we need to borrow, we are in negative cash. So that's where the negative sign will come in. So we'll take that cash with positive sign, and we will add it to the revolver balance. So the revolver will grow. If we have cash flow before revolver positive, the way I have it here on the slide, it's a fairly small positive number, 4 million compared to 14 million balance. If the cash flow is positive, then we'll take it with negative sign and reduce the amount of revolver by that cash flow. And then in the third case, imagine if our cash flow was huge. If it was like 100 million with 40 million revolver balance. So that minimum formula would allow us to pay down just the right amount we need to eliminate the revolver. So that's that third case, and that's where this minimum formula comes in. And as you'll see, it's actually a very flexible calculation. Like if you need more cash, then you grow the revolver. If you don't need it, you pay it down. So that's the balancing line on our balance sheet. And then we'll kind of build it as any other type of debt. We'll calculate the interest expense on the revolver. That's the end of my introduction, the end of my slides. We'll jump into Excel, and hopefully I keep it entertaining enough, because it could be somewhat dry, going cell by cell. But I think that you'll find it useful, and you'll have to do similar thing on your own as part of your assignments. Again, I found this independent practice to be key component of this lab. It's one thing when I show you and you follow my directions, but I'd like you to try it on your own. So hopefully that makes it challenging enough for you. And just my last slide here. when we do financial modeling, here are some suggestions, especially for formatting. Try to keep the fonts the same, label pages the same way, set them up for printing. Excel doesn't come such that you can print files. They all come like in strange format. And I'll show you in Excel how to do that. Keep this color coding convention. When your inputs, your hard codes are blue, and then the formulas are black. And sometimes what I do is marking links to other pages as green. Kind of, keep the formatting similar. 1 decimal point for dollar amounts. No or 1 decimal for percentages. Don't leave like large number of decimals after the point. So with that, I'd like to turn into Excel and start this modeling exercise. It's going to take us probably a few hours, until we're all done. It'll be 3 classes, pretty excited about it.